Hi everyone, you're here with Zoe Arthurs from Business Basics. So I thought today we would pick up the theme of financial performance. If you've seen my previous videos, then you'll see that we've covered break even. So today I thought that we would have a go at covering cash flow. Now, one of the easiest ways to explain cash flow is thinking as it as if it's a wave. So money will come into the business, so the wave will come into the shore, and we hope that these waves will be quite large because obviously that means profitability. And then the wave will retreat back out to sea, and with it, it will take some expenses and some costs that we have to incur within our business. So if you think of it in terms of your business sort of flowing money through and in and out of your business, then cash flow really is quite simple. Now, the chances are I'm going to probably have to break this into a couple of lessons for you, just because cash flow is so large. But just so that you are aware of the topics that we're going to be covering across the two tutorials today, we're going to have a look at analysing your financial performance. And that means basically understanding how to construct and analyse your cash flow forecasts, understanding what an inflow and an outflow is and how to calculate your total net cash flow, and the use of data for financial decision and planning. Now, it's really important with cash flow that you do understand that, again, this is a prediction. It's there to identify how much money you need in order to make your business profitable and also to cover its overheads. And then we're going to have a look at ways of improving your cash flow and obviously the difficulties that we're going to incur as a business. Now, there's lots of different variables with cash flow, so please be aware that I am only covering the very basics just to get you started, but hopefully you'll see from this tutorial that the information I give you will be enough for you to construct your own basic cash flow. So just so that we're really clear on the terminology, the cash that flows into our business could be from sales of our product or services. It could be payments from our debtors, so people who owe us money. It could be from capital invested. Perhaps we've had savings, or perhaps we've had some investment to start up our business. Or it could be from sale of our assets, so things the business owned, or perhaps a bank loan. So that's all money that's flowing into our business. So it's coming in and it's making our current business state of affairs quite cash rich. Okay, so it's showing we have money in the bank. And just so that you're aware, in a comparison, our cash outflows, so the things that will take money away from our business, could be the purchasing of stock. Perhaps you're having to buy a particular product to make it into something else. Perhaps you've got salaries and wage bills to pay for. Perhaps you owe debts, or you have bank loans, or perhaps that you actually owe your suppliers, i.e. creditors, money, or you may need to buy a new vehicle in terms of an asset or a new piece of machinery. So cash flow is basically interested in the balance between these two. So it's the cash inflows on the left and the cash outflows in the right. And it's all to do with the size of the inflows against the outflows and the timing of these cash flows, which will make your business profitable and also run really well. Okay, so it will make sure that it has enough cash in the business to function adequately. So cash flow is important to a business as it needs to ensure a positive cash balance. So it has to basically meet the day-to-day expenses of your business. There has to be enough money in there in the bank account for your business to operate on a daily basis. And that's why timing is so key with the cash flow. If you have too much money going out and not enough money coming in, the chances are your business will start to accrue debts quite quickly, and it will actually lead to the shutdown of your business in the very early stages. And a cash flow, as I said at the beginning, is a forward-looking statement. It's a prediction. So it's all about trying to identify what you estimate as best as you can, okay, and it is a researched guess, how much your inflows and outflows are likely to be. So that doesn't mean over-egging your sales figures. That means taking a realistic view of what you think your cash in and outflows will look like. A cash flow statement is looking backward. Okay, so there's two things. There's a cash flow forecast, which is what we're going to have a look at, and a cash flow statement. And what you need to do is, as your business grows and you move forward in terms of the amount of months that your business is sort of starting to trade, is you learn lessons from your cash flow statement, and you look backwards and see how close your predictions were. And if they weren't close at all, then the chances are you really need to spend some time looking and estimating at what your cash inflows and outflows are going to be in the near future. A potentially profitable business may fail because it has cash flow issues. And as I said at the beginning, timing is key. What you're ultimately looking for in a business is long creditor days. So that basically means that you're looking to negotiate with your suppliers the longest possible period of time that you can pay. So it may be that you're not paying your invoices for 20 or 30 days, but you're hoping that the money that you're going to get in from your debtors, so people who owe you money, is going to be really short. So you want to make sure that money coming in from people who owe you money is really short, so 1, 2, 3, 4, 5 days, and the money that you're spending out in purchases to your suppliers is as long as possible, because that will give you a positive cash flow. That will give you a large amount of days in between in which you are able to reinvest the money that's sat in your bank account should you need to. So we're going to have a look at how to construct a cash flow forecast. And that means that we're going to have a look at a range of different cash inflows. I gave you a couple at the beginning of this tutorial, but just so that we're really clear. And then we're going to have a look at the cash outflows and the differences between the two. So a cash inflow, as I said, could be some sort of owner's investment. It could be where you've had savings in your bank account and perhaps you've put in £5,000 or £10,000 just to get your business started. It could be cash sales estimated from your sales forecast. So it could be, for example, that you estimate that you're going to sell 1,000 t-shirts within your first month of training. But remember that this is not a good point to over-egg your sales figures, because you may over or underestimate, and that will be deem your whole cash flow forecast completely pointless. You have to have some extent upon research. It's really important. Researching your cash flow ins and outflows is really important. Please don't guess, because actually it renders the whole exercise pointless. And when you do come to file your tax returns, or you file your bank or your cash flow statement along with the rest of your profit and loss and balance sheets at the end of the year, it will just show as a pointless exercise. So it's more difficult for new businesses to predict their cash flow because no one really understands how much things are going to cost. And we fully appreciate that as entrepreneurs. I certainly found it very difficult to predict how much my cash flow was going to be in those early stages. But you really do need to spend some time researching this. Maybe get a business mentor or have a look with similar businesses and have a look and see what their cash inflows and outflows are. And it would be really good for you just to benchmark what you think your costs are going to be against another business of a similar scale. Your credit terms offered to your customers in your early stages of starting a business are likely to be really short, if at all. They're likely to want cash up front, and it's up to you as the new business to start building that trust and making those relationships with your suppliers so that you can actually increase those days, those creditor days where you don't have to pay for money that you haven't yet generated through sales. So that's the inflows. Let's have a look at the outflows. So your forecast for your cash outflows, when it comes to your fixed costs, and remember these costs stay exactly the same. They're things that, they're costs that if your business didn't incur, you couldn't operate. So if it's things like rent, for example, or your rates, or perhaps your vehicle, then you should be able to estimate these on a month-by-month basis, and they should be quite simple. Just be aware, though, that there is a time delay between estimates and signing contracts, and sometimes that can cause inaccuracies. So whereas you are trying to record an outflow as perhaps being £500 in May, it may actually impact your cash flow in June based on the dates of your contracts. So just be aware and make sure that you do tighten up the finer details. Your payment of your variable costs. So if your sales are difficult to forecast, and let's be honest, when it comes to a new business, they often are, it's important that you try and anticipate what your demand is. And you would have done this through your extensive market research, because you would know where your customer pain points are. I know I keep saying it, but you will then be able to identify exactly what your customer is expecting from you and what they need in order to meet their demand. And don't be afraid to put in there a contingency for unforeseen expenses. You don't know, for example, that your business isn't going to incur the next great flood. So just be aware that you have planned for contingency. Every great business person does it, and it must be recorded on the cash flow. So I'm just going to leave it there for this tutorial. I've given you a huge amount of information, but what I strongly recommend you do now before we go any further is that you just make a very crude list of your cash inflows, so things that you think are going to be coming in towards your business, and your cash outflows, so your fixed costs, your variable costs, and what you predict your sales figures to be. And from that, I will show you a very simple table format in which we can then create a cash flow forecast for you, so that you're now getting to grips with your financial recording. Thanks for watching. I'll see you over in tutorial 2.